The reason that 80% of all companies fail is because they do not understand the true cost of growing and operating their companies. The cost of sales, how you compensate, how you manage cash flow is going to determine your success or failure in the business. So stick with me as we walk through the essential components of operating a truly profitable sales center.
Welcome to the Launch Capsule. With your host, James DuBos. Buckle up because your launch capsule begins now.
Liftoff. We have a liftoff.
Hello there, this is Jim DuBos, and welcome to this edition of the Launch Capsule. In today's episode, I want to focus on the cost of sales. Sales growth is obviously the key to growing revenue in the business. But understanding the cost side of the equation is critical to the long-term success of the business. When you're establishing a sales goal, one of the things that I think is most critical is knowing what is your average transaction margin, meaning I know on a per transaction basis, I know what the average gross margin is. 10%, 15%, 20%, 30%, 40%, whatever the number is. The first measurement I want to talk about is average transaction margin. If you're selling a product, the gross margin is revenue minus the cost basis, the cost of goods sold, renders you a net. And when you divide that net into the revenue, you get a resulting percentage. That is your average transaction gross margin. Because then from there, those profit dollars will start to flow into the operational expenses of the business. On the service side, the calculation is simply, I've sold a unit of service. I have a cost basis, which is going to be driven by labor cost, fully burdened labor cost, which is generally going to be the hourly or monthly expense associated with the rendering of those services, along with overhead. And then you allocate that cost to that unit of service that you've sold, giving you a resulting gross margin, dividing again the gross margin into the revenue, and you get a gross margin percentage. So fundamentally, you should know the gross margin on a per transaction basis. And you should have already set an expectation that if I did more of this, this is how I want to grow my business. Vern Harnish, who wrote the book Scaling Up, in some of his conferences and talks says, companies make 80% of their operating margin from 20% of the things they sell. It's a very interesting thought if you think about it, because you probably have at the very least a classification of product or services that you're selling, and you can see a repeated transaction going on inside of your business, and you can point to and say, gosh, that is the one or two things that are being done over and over and over again in my business that are driving revenue and resulting in operating margin for the business. The key here is asking, am I applying an appropriate compensation approach for growing the business? And am I contemplating all the various costs associated with this decision to grow? When you grow with sales, you're going to add, at the very least, a head count associated with owning the growth of the business, meaning I want to grow my business by $1 million. Well, you're assigning that growth goal to an individual who then expects to be compensated as they execute against the growth goal. There are two different types of compensation as it relates to sales growth. The first I'm going to talk about is going to be singular transaction-based sales growth. So when an individual sells a new transaction and it results in a transaction operating gross profit, they expect to be paid. My own experience has taught me that this commission-based compensation is going to fall between 15 and 20% of the profit, the gross profit of that transaction. The key to compensating on gross profit is you incentivize the sales resource by driving the more profit in the deal, the higher you get paid. The second component of this in these one-time transactions, regardless if they are product-based transactions or labor-based transactions, is to pay the account resource, the sales resource, when you are paid, when your invoice is paid. So not only are you paying on profitability of a deal, but you're also paying when you get paid. So your cash flow is not negatively impacted while you're waiting to be paid by the customer. So an example, I sell $1,000. My cost of goods sold is $650, so I have a $350 gross margin. You pay 15 to 20%. That commission payment is deducted from the gross margin, resulting in a net margin that flows into the operating expenses of the business. The key, by not compensating until you receive payment, the only carrying cost you might have would be the product acquisition cost if it was a product sale, along with the operating expenses of the business, which is why your collections window needs to be as short as possible. Typically, the goal is net 30 or below. When you compensate this way, the carrying cost of the sales resource should not be more than 25% of the total compensation that the individual is expecting to receive. So, as an example, if the individual is expecting to receive $350,000 as their target compensation based upon the amount of revenue that they're carrying for the company, then you have a maximum amount that you should be paying them for a base salary. My expectation is that the base salary for traditional account executives will run somewhere in that $40,000 to $80,000 a year, depending upon how experienced they are and what is the size of the book of revenue you're expecting them to generate for your business. So that's the cash flow that you have to prepare for while you're waiting for this to generate additional revenue and operating margin into the business. So I generally tell entrepreneurs who are starting, expect a 90 to 180 day runway with account executives turning on new revenue in the business. Sure, good things can happen and you could have a 30-day window, a very quick turn on operating margin for the position. But you need to be sure that you're thinking about how am I going to cash flow this over the 90 to 180 days while I'm waiting on this revenue to be executed. And we're going to talk about reporting and some of those things to make sure that you have the right indicators as you go through this waiting period for revenue to ultimately trickle into the books. But the key here is making sure that you're not exceeding a certain cost of sales as a total percentage. Again, my own experience in growing with sales teams is that my total cost of sales, meaning the cost of the sales team, any administrative overhead associated with administering those sales, any engineering or technical quote validation resources that we had inside the company, making sure that what we were quoting to customers was accurate and was going to render the business solution that they wanted, that total percentage of revenue did not exceed 38% in the business. Because what's going to happen is you're going to be applying those costs. Those are operating expenses that are going to ultimately eat away at the operating margin in the business. So you're going to want to be sure that you're measuring your cost of sales, because that is a component of the overall operating expenses in the business. Obviously, you have things that are outside of sales that are a component of it, but this is a major factor in the erosion of operating margin in the business. Now, look, in the beginning, in the early days of my companies, sure, I've had cost of sales in the low to mid 40% range, because I was aggressive in trying to grow sales. And then over time, I brought that cost of sales down to optimize the company operating margins. But in general, know that you have to pay attention to how much the cost of sales is, because it is the number one erosion in your operating margin as an entrepreneur. If you think about the one-time percentage being 15 to 18%, well, what does that look like in a recurring revenue model? So if you sell $1,000 monthly contract and it's a 36-month contract, well, you just sold a contract of $36,000 total contract value. Your cost of delivery is going to be any labor associated to render those services, along with any product that you need to render the service on behalf of the customer. Generally speaking, your target gross margin for these types of services should be in the 65 to 70% range. If they're not, you're probably underpricing your solution. So when you render that service and you sell $1,000, you have a $650 margin. The cost associated with that is going to be, now I have to apply a 15 to 20% commission against the gross margin of that contract, but it is paid monthly, and it is paid when we receive the cash from the customer, when the invoice is collected. So it's a monthly recurring payment. The account executive wakes up every month going, I should have new dollars coming to me in the form of a monthly dividend, as long as the customer continues to pay their invoices. The good news for the business owner is, as you build this book of business for an account executive and they get more and more recurring contracts, you have a stability of revenue and profitability. They have a stability of income every month. So the likelihood that the account executive is going to leave your business and go to another business is very low, because they are attached to that built-in revenue, that built-in income with the company. And because it's tied to invoice collection, they have a vested interest in making sure that the customer pays on time, the customer is satisfied, those types of things. Again, 15 to 20% was the average running commission that we would pay on those. The beauty of that is when we go to looking at renewals of contracts, we learned that we should pay at a renewal time a lower percentage for the renewal versus a net new, with an exception. Basically, a renewal, I would pay roughly 10% for the renewal as a commission amount. The reason for that is because we wanted our account team members constantly looking for new business. And new business could come one of two ways. I could turn the $1,000 a month customer into a $1,500 to $2,000 a month customer by adding net new services, which would then trigger it being treated as a net new contract sale. So they would get paid the 15 to 20%. Or I could find a whole new customer. and sell another $1,000 a month agreement and get paid the 15 to 20%. So it always kept the account team member hungry when they were out looking for new business. They definitely were servicing their customers along with looking for new business. Now, the reality is that an account team member can only handle and manage so many customers. And so each year, we would look at our book of business, our customer community, and say, how do we need to move or realign customers with other account managers to be sure that customers are serviced at a high enough level, and we leave enough room in the existing account managers community where they can derive and hit their ultimate individual goal of compensation, and at the same time, there's a percentage of growth associated with revenue as a whole. So if I'm just I'll use a general number. If I want to grow the business by 30% year over year, I've got an account team of 5 people. Well, then I'm going to distribute that 30% across all 5 of those team members. So everyone has a growth goal component to their compensation. Now, the last thing I'll say about comp is there needs to be a performance-based comp for your ones who exceed goal. And the way we would do that is, let's just say, as an example, you're an account team member and you have a $3 million annual goal number as your goal. So at 100% of your annual number, you're going to generate, just going to use an example, $200,000 of additional compensation, commission compensation for your production. But let's say you have a great year and you knock it out of the park and you go to $4 million. Well, you exceeded goal by your percentage. And for rough math, let's just say that it was a 30% exceeded. Well, we would pay the commission based upon the percentage of your over, as we call it, against that goal. So if I did $4 million on a $3 million goal, it's roughly 30%. So therefore, I would get paid 130%, 18% times 130%. So what you're really doing is you're rewarding those individuals who are really executing over and above their target goal. And account managers or people who are motivated by compensation love these types of stretch goals because they know if they have an opportunity to knock it out of the park, well, they get to knock it out of the park with their personal compensation. So you're happy because they're hitting their growth goal and they're exceeding their growth goal. And at the same time, they're happy because they get compensated for the execution associated with their business. So look, I hope this helps you in thinking about the cost of sales and thinking about cash flow and what are going to be the things that you're going to need to contemplate in the carrying cost associated with the business. So I hope you have an awesome day, and I look forward to talking to you in the next episode. See you soon.
That's a wrap for today's episode of The Launch Capsule. With your host and mentor to success, James DuBos. If you enjoyed today's episode, don't forget to subscribe and share.